So our first speaker for today is Junaid Bray from Laurium Capital. Junaid is a portfolio manager on the Nedgroup Investments SA Equity Fund. If you look at Laurium and the way that they manage money, they very much focused on kind of two concurrent approaches. So the traditional approach of valuation based, as well as looking at the macroeconomic context, and as well as taking advantage of special situations when these do arise. Junaid, welcome, and how are you?
I'm good, thanks Anil. How are you?
Yeah, brilliant, brilliant. So Junaid, we'll hand over to you for the next 15 minutes or so, but before that I just want to remind our audience that you can use the button at the top left of your screen and submit live questions for all of our speakers this morning. So Junaid, thank you, and over to you.
Thanks, good morning everybody, thanks Anil. So just a reminder on the Nedgroup SA Equity Fund that we manage. The fund is fully invested in SA equities only, doesn't directly invest in offshore equities, it's JSE listed only, and the fund is fully invested in the market, so maximum of 5% cash. So we think it's a good building block for your portfolios. So if we just look at the performance and what the fund's performed like over the recent past and the longer term track record, we've had a very good year so far. Alpha of about 5% against the JSE Caps Wicks, and you can see that sort of filtered through into 1 year. And if you look at our 5-year track record, the performance is about 2% of alpha over 5 years, and since inception about 1.6%. So alpha across all periods. And then a stat that we like to look at, which points to the consistency of the performance of the fund, is if you look at rolling 3-year periods and rolling 5-year periods. So if you look at the bottom table, and specifically the middle column over there, what that says is over rolling 3-year periods, 73% of the time we outperform the Caps Wicks benchmark. And you can see that rolling 3-year periods has 64 data points in there. So it just highlights the consistency of the fund. And also if you look at rolling 5-year periods, that's 80% of the time that we've been outperforming the benchmark. So that just speaks to the track record of the fund. If I look at graphically what that looks like, the top line is the performance of our fund. And you can see that against the teal line, which is the next one, which is the market, and the black line, which are SA equity managers who invest in the JSE only. You can see the outperformance of our fund over time graphically on this chart. So just a quick snapshot of where that performance has come from. If I look at, for example, just of the last year to date, you can see, a big part of the outperformance has come from not owning any MTN. We felt that MTN was quite overvalued when it got up to north of 160 Rand to 200 Rand. We sold out of MTN completely. And as MTN came all the way back down, that benefited the fund performance quite nicely. We had a significant position in Mediclinic. We felt the company was significantly undervalued. And it was very well run, geographically diversified with operations in Switzerland, the UAE and South Africa and the UK. And we felt that in a post-COVID world, occupancies would recover, and you could see that coming through quite nicely. And then you saw an offer from Remgro and Mediterranean Shipping Company. Remgro had already owned 45% of the company, and they made an offer for the company. So the share prices has picked up quite nicely over that period. And then also just generally, having exposure to British American Tobacco, which has been a sort of a core position in the fund, as well as having resources like Sasol, SAPI, and banks, Standard Bank and ABSA, for example, which has outperformed the market quite nicely, has all benefited the fund performance. Of course, we won't get everything right. So, what has detracted from performance has been positions in Anglo Gold, Momentum, Telkom, and Aspen, which has underperformed over this period and has dragged down performance. But net, we've delivered 5% of alpha year to date. So just a quick review of the market. And as Anil pointed out in his opening comments, we've seen a very volatile period since the beginning of the year. We already had, inflation and interest rates rising. And then into this, when the Russian invasion of Ukraine took place, that was another jolt to the market, another jolt to supply chains, and a step up in inflation as, commodities were either under sanction or, in the process of being sanctioned. So we saw another dislocation there, and then the rapidly rising interest rates as a result of that has obviously risen saw a rise in the cost of equity and the cost of capital. So you've seen markets come off. Within that context, I think this slide and this chart really just highlights the volatility, and you can see actually within this context, domestic South Africa has actually performed reasonably well and outperformed global markets. So you've seen the MSCI World and the S&P 500 down about 20% year to date until the end of June, whereas domestic SA has only been kind of fairly flat, with the caps wicks down about 5%, and then our domestically listed foreign companies falling more than that. So our domestic markets have actually performed reasonably well year to date. And we think a big reason for that is if you look at starting valuations were attractive to start out with. So I think, that which already baked in quite a margin of safety. Our local market also had a reasonable exposure to resources and banks, which have performed reasonably well. So if I look at this slide shows you the dark green line is the SA equity market. And you can see that valuations now are still very attractive. We're trading at discounts to other emerging markets as well as global markets. And you can see that historically we used to trade at a premium to emerging markets. That shifted to a discount which prices in a lot of the SA macro concerns. And if you look at a lot of the global markets, they've pulled back. But we think that, they haven't really factored in earnings downgrades yet. So the real PEs are actually a bit higher, whereas a lot of our companies, we've already seen quite a bit of earnings downgrades coming through. So the interesting thing about our market, if you split the market into the domestic component as well as the foreign component, this slide just shows you a custom index that we build of domestically focused companies. So mostly your banks, your retailers, your SA industrial companies. You can see that we're trading almost 2 standard deviations cheap, which we think is quite attractive. We're seeing a lot of opportunity, a lot of upside in a lot of domestically focused companies, particularly the banks. And importantly also, if we look at the foreign companies that are listed on the JSE, and this is just a snapshot of a few of them, of the bigger ones, you can see they've also pulled back and they're also trading 1 standard deviation cheap. And I think the important point to point out here, if I look at a company like Tencent, obviously we invest in Tencent via Naspers and Prosus, we've already seen a significant series of earnings downgrades coming through. So you're buying the company at a cheap multiple with earnings downgrades already baked in, whereas a lot of the global markets have not really seen a series of downgrades come through yet. So just to give you a snapshot of how the portfolio is positioned, we still like the global consumer space. So we continue to hold British American Tobacco as a core position in the portfolio. It's performed very well in this environment where you'll pay up a little bit more for defensive earnings and pricing power in an inflationary world, both of which British American Tobacco has and still offers you a 7% dividend yield, which is growing in this environment. The company is also engaged in share buybacks and has been de-gearing its balance sheet. And then Naspers and Prosus, we were very pleased with the buyback announcement a couple of weeks ago, where they'll be selling down Tencent to fund buying back Naspers and Prosus. So effectively, management's you're buying the same company back, but at a big discount. So that goes a long way to narrowing the discount, which we think is working. And then at the same time, we think Tencent is cheap as well. So we think there's scope for the discount to narrow, and we think Tencent is undervalued. So we continue to hold a significant position in Naspers and Prosus. And then selectively, we have been adding to other global consumer names as well, where we feel valuations are attractive. And then healthcare stocks, it's another significant position in the portfolio. So we've had a substantial position in Mediclinic in the fund. We're very pleased with the offer that's come through for the company. And we still think there's a good earnings recovery story as occupancies recover in a post-COVID world. Then if I look at, SA financials, we've got a significant exposure there, particularly to the banks as well as insurance companies. We think that in a rising rate environment, you'll see net interest margins increase on the one side. And we think they've got enough provisions built up, because you will see credit losses pick up, but we think they've got enough of a buffer on provisions on that side. And then we've got a significant exposure to resources as well, particularly the energy complex, oil, coal, etc. We think that We've seen a lot. The supply-demand environment, we think it still remains tight. So even though there are recessionary fears and risks rising, we think that the supply and demand situation with the Russian-Ukraine situation impacting that, we think that the supply and demand situation remains very tight, and it's supportive of commodity prices and mining companies. Overall, if I just give you a snapshot of how the fund is positioned from a sector perspective, about a quarter in global consumer stocks, about 13% in banks, and then we've got a good selection of resource companies from the diversified miners to Sasol, to Mondi and Sappi, and then PGM exposure as well, and then a reasonable exposure to retailers, as well as some SA domestics on the other side. And then the chart on the left, if we split out the portfolio from a bottom-up perspective, about a third is directly exposed to SA Rand valuations and earnings, and the rest is diversified across emerging markets, which is largely Tencent, and developed market earnings. And that gives you a snapshot of the portfolio. So that's just the top 10 positions in the fund. I've spoken to many of them. I'll hand over to Anil and see if there are any questions from the audience.
Brilliant. Thanks, Junaid. I always do enjoy how you explain things so nicely. It certainly helps with the clarity of understanding. So there's actually a couple of questions that have come through around commodities in particular. So, just given how reliant South Africa is on commodities for the trade deficit and tax revenue, as well as just given the high weighting of commodities in the fund as well, it does make it quite an important topic. So the question is about, just with the expected global slowdown and the negative potential impact on our economy, especially if you bring in load shedding, inflation, and the fuel price hikes as well, what do you think about the profitability of these kind of commodity companies and kind of the outlook in terms of your view for the portfolio?
That's a very good question, Anil. It's a question we keep asking ourselves as well internally. You do have a complex situation at the moment, but as I mentioned earlier, I think you first have to look at things from a supply and demand perspective. So I think, supply and demand is expected to remain fairly tight, especially on the energy complex. As the world continues to reopen in a post-COVID world, the demand for fuels especially, we think, as the world uses more oil again, and especially for energy consumption, for power generation, coal as well, I think we were maybe a bit too quick to switch to renewables, and you can see the disruptions to power generation and the need to bring coal back, just to keep that transition. And we have had weather-related issues again in Australia, which is, hindering the coal production as well. And we also think, importantly, there's been an underinvestment in new supply. So you're not going to see new supply coming on stream anytime soon, as when your demand's picking up. So we think fundamentally that's your starting point. Demand is likely to soften a little bit with recessionary fears, and often the cure for high prices is high prices. So, with the high prices in fuel, you may see some, a bit of a softening on that side, but we think net, you're still in quite a tight situation. And then cost inflation is something that it's been coming through everywhere, and the miners are not immune to that. So their costs are picking up as well. That is a common theme as miners report results. You are seeing cost inflation as highlighted as a concern. So, but net, we think that, the overall commodity price still supports these companies. And if we look at the spot free cash flow yields on many of these companies, you are trading at double digit or almost 20% in many of them. So we still like many of them, especially the energy related commodities.
Thanks, Junaid. We actually still have a couple of more minutes here, so I'm going to try and squeeze in as many questions as possible. So the next one is about Tencent, and how much did Naspers sell already, and what's kind of their future plans in terms of what they've communicated, as well as what you think in addition to that, what may be coming.
Sure. So Naspers Prosus owns about just under 30%, about 29% of Tencent. They've started on their sell down, and will use those proceeds to buy both Naspers and Prosus. So I think the key message that they sent was it's an open-ended buyback. So they haven't mentioned the numbers as to where they'll settle at, but the stake in Tencent is so big that it will take a very, very long time to sell down and buy the equivalent on Naspers and Process, you've got years of runway ahead of them. So we think, probably sell, there isn't really a number that they've given, but I think, they could end up selling down, 5% over a period, and still end up owning a significant part of Tencent. It doesn't disappear. So we think there's a long runway, and we do think it supports the discount narrowing over time.
Okay, great. And Junaid, the next one is about if you have any small caps in the fund.
So not many of them. We do selectively because you weigh it up against liquidity, etc. But an example of a good company that we do own in the fund is Udeco. It's a very well-run SA industrial company focused on the industrial space, and they've run the business very well. So when you've seen competitors and peers falling over, they've come in and they normally look for good companies to acquire, and you're buying, and they've grown earnings very well despite the tough macro environment, and continue to grow earnings, north of 10%. It's a very good, well-run company. Then we've also got another mid-cap company in the portfolio. It's not really small; it's more tending towards the mid-cap space, which is Motus, a very well-run motor dealership business. So many of these companies, during COVID, they cut costs quite aggressively because we had expected a very weak macro environment and a very long time to get back to pre-COVID levels of economic activity. Clearly, we've actually picked up back to pre-COVID levels much quicker than many people expected. I think within 2 years, we're nearly there. So these companies have actually cut costs, and now that they're getting the volume recovery coming through, they're getting that operating leverage coming through quite nicely. So earnings are significantly above for Motus. I think they're going to print about 18 Rand this year. They used to do about 11 Rand pre-COVID. So generating a lot of cash and great little business. So we own some of these in our portfolio.
Okay, great. Thank you. The next one is about just given where kind of developed market valuations have kind of dropped to now. Are you seeing more opportunities there, and just kind of questions around your geographic and currency exposure? Where do you think that's going to move to in the near future?
So it's difficult to the timing of the markets and things, but I think you have seen valuations pull back. So you've seen that your P's have derated, but you haven't seen the earnings downgrades coming through for many of these markets. The S&P 500, in fact, it still looked like there were earnings upgrades until recently. So when you adjust for a possible slowdown economically, we think that you have to see probably an earnings pullback coming through, which means that the P's are actually a bit higher than what you're seeing at the moment. We think that from our fund perspective and a geographic diversification perspective, I think we've got about a third of the fund in SA Rand only earnings. And then developed market earnings, I suppose, or dollar hard currency earnings, it speaks to the some of the multinational companies listed locally. So I think not every dollar earnings is the same. So it depends on if you've got a defensive company earning dollar earnings or euro earnings, and I think we've picked up many of those in our fund. So the likes of British American Tobacco, defensive earnings. We've recently started buying more Anheuser-Busch. Also, but a little bit of pricing power there, and coming through quite nicely. So I think there have been some earnings downgrades already. So we think that those companies earning dollar earnings that are relatively defensive in the portfolio.
Okay, great. And maybe just the last question. We've got about 30 seconds left, kind of related to your answer there. What are your thoughts on the benchmark in terms of ALSI versus CAPSWIX, and just in the context of the size of the fund as well?
So I think CAPSWIX is probably a better benchmark in the sense that it downweights some of these companies, because you don't want a benchmark that's too exposed to any particular stock or sector. So I think it does a better job. With the growth of Naspers and Process, it's still sitting at about 14% of the benchmark. But I think it's still the CAPSWIX is still a better reflection, or more fair reflection compared to the ALSI, where you've got something like Richemont, I think, which is a very, very big position in the ALSI, which I think so the CAPSWIX has got a more broad. It's a bit less concentrated than the ALSI, I think.
Yeah. Okay, Junaid, thanks very much. We always appreciate having you, and we appreciate your time.
Thanks, Sunil. Thanks.
Thank you.